Hello everyone. Today we're from Group B. We're going to present it about intangible assets. Before we present it, I will introduce my team. At first, there is Janice Marella P with last digit NPM 251, Talitha Novia R with last digit NPM 358. The next is Ignatius Ardino Miskha with last digit NPM 121, and next is Prita Luneta K with last digit NPM 171, and the last is me. My name is Nabilah Nur I with last digit NPM 096. At first, I will explain about the characteristic of the intangible asset. The first characteristic is identifiable. It means intangible asset can be separated or sold or maybe can arise from the legal or constructual rights. The second is no physical form, means intangible asset is a value comes from rights and benefits so not have a physical form. It, for example, is brand and patent. The last characteristic is non-monetary, means that intangible asset is not cash or claims to cash. The second is valuation of intangible asset. The first one is purchased intangible asset is recorded at cost, and the cost is included as purchase price, legal fees, and other necessary expenses. And if the cost is insane for use fair of what is given or received. The second is internally create intangibles, or called R&D. R&D has two phases. The first phase is research phase. This phase is the valuation that have always expands. The second is development phase. It pays that had capitals only if the project is economically viable. The next is I will explain about the amortization of intangible assets. Amortization means allocation of costs over time to time. The first one of characteristic is the limited time intangibles. So it means have a finite useful life, like amortized over useful life, like the method of the based on usage pattern, and if the method is unclear, use strike line method. The factor of affecting useful life is like the usage, obsolescence, legal limits, maintenance level, and industry or technology changes. The second characteristic is indefinite life intangibles. It means that intangible does not have predictable limits or trademark and also not amortized and must be tested for impairment annually.
Okay, so now I will explain the first three types of intangible asset. So the first one is marketing related intangible asset. These assets are mainly used to promote products or services and help companies build their brand identity. Examples include trademarks and internet domain names. For example, a logo, brand name, or website can help customers recognize a company more easily. In accounting, when a company purchases a trademark or spends money to legally secure it, these costs are usually capitalized, meaning they are recorded as an asset instead of an expense. However, costs such as legal protection or maintenance after acquisition are usually expenses. So the second one is customer-related intangible asset. These assets are created from relationship with customer. Example includes customer list, customer database, and order backlogs, which mean orders that customer have already placed but not have been completed yet. These assets are valuable because they help company maintain future sales and customer loyalty. When a company acquires customer-related asset, the acquisition cost is capitalized. Since the asset usually have a limited useful life, company must amortize them over the period, usually using the straight line method. And the third one is artistic related intangible asset. This asset relates to creative work such as copyright for book, music, movies, photograph, and other artistic material. A copyright gives legal protection to creator and allow them to control how their work is used or sold. Company capitalize acquisition costs related to copyright. However, research and development costs are generally expensed, not capitalized. Because artistic related assets normally have a limited useful life, company amortize them over the useful life or legal life, depending on which period give benefit to the company. So these are three types of intangible assets are important because they help company build brand value, maintain customer relationship, and protect creative work. Hello, my name is Talitha Novia R with the last three digits of NPM 358. And now today I will explain about the learning objective 2. This is about various type of intangible asset. So first of all, what is intangible asset? So intangible asset are assets that do not have physical form, but they are still important because they give value to the company. For example, a company may have a famous brand name, customer data, or technology that helps that business grow. In accounting, there are six main types of intangible asset. So the first one is marketing related, then customer related, artistic related, contract related, technology related, and the last one is goodwill. So each type has different example and different accounting treatment, such as capitalization and amortization. And now we're going to discuss it one by one in the next slide. Okay, so now I will explain three other intangible assets. Start from contract related. So um, these assets come from legal agreements such as franchises, license, and broadcast rights. Companies capitalize acquisition costs. If the asset has limited life, it is amortized, but if the life is indefinite, it's not amortized. And the second one is technology-related intangible asset, such as patent. Patent give companies legal right to use or sell an invention. Companies capitalize purchase and legal costs, while research and development costs before economic viability are usually expensed. Since patents have a limited useful life, they are amortized over the useful or legal life, whichever is shorter. Lastly, we have goodwill. Goodwill only happens when a company buys another company for a price higher than the fair value of its net asset. It represents things like reputation, loyal customer, and strong management. Goodwill has an indefinite life, so it is not amortized, but company must test for the impairment. So in the conclusion, these assets are important because they give legal right, protect innovation, and increase company value.
Okay, for the next matter, we will talk about goodwill. So, the goodwill is measured as the excess of the cost of the purchase over the fair value of the identifiable net assets, like assets less liabilities purchase. For example, if Portofino paid to $2 million, $2 million to purchase Aquina's identifiable net assets with a fair value of $1.5 million. Portofino requires goodwill of $500,000. That is why goodwill is sometimes referred to as a block at a gap filler or a master valuation account. So the first part of goodwill is how we recording the goodwill. The first one is internally created goodwill. So the goodwill generated internally should not be capitalized in the accounts. So the second is purchased goodwill. So the goodwill is recorded only when an entire business in purchase and goodwill is the residual, the excess of cost over fair value of the identifiable net assets acquired. For the next, we see the example for purchased goodwill. So, Feng Ying wants to acquire Tractorling SA in Brazil to support its tractor distributorship business. So, we can see at the picture on the right side at the statement of financial position, that is the asset contains with PPE, inventory, account receivable, and cash, and the total is $255,000. So, to know, we know that the liabilities is 55 on the fair values. We can see the liabilities is 55. So the total of asset is $255,000 is minus with the liabilities, which is $55,000. So the value of the net asset was $200,000. But before the acquisition, Feng agreed to buy the company for $4,100. So Feng investigated the fair value of Tractor Link's assets and liabilities. And we can see at the on the picture on the left side that is contains PPE and then patents, inventory, accounts receivable, cash, also liabilities. So the total the for the asset and the liabilities is $350,000, which is like the Fang agreed to buy company for just $4,000, and then the fair value of net asset is just $350,000. So since paid the $400,000, while the fair value of net asset was only three three hundred $350,000, the remaining is $50,000. It's from $400,000 minus with $350,000, and then it was recorded as goodwill. Okay, this is the like the list or rincian where we get how we get the $50,000. So this is the like the list like that PPE, patents, inventory, accounts receivable, cash, its total, and then minus with liabilities, and then the result is fair value of net identifiable assets, and then the purchase price is $400,000, which is $400,000 is minus with the fair value, so the value assigned to goodwill is $50,000. So goodwill is viewed as one or a group of unidentifiable values or intangible assets, the cost of which is measured by the difference between the cost of the group of asset or enterprise acquired and the sum of the assigned cost of individual tangible and identifiable intangible assets acquired less liabilities assumed. So, a company often identify goodwill on the statement of financial position as the excess of cost over the fair value of the net assets acquired. So this is the journal, like how they how they record. So after we talk about the purchase goodwill, so after that we talk about goodwill write off. And goodwill is considered to have an indefinite life, so companies do not amortize it. Instead, they only reduce its value when it becomes impaired. This method is used because it is difficult to estimate the useful life of goodwill, and investors find amortization less useful. Although some argue that goodwill should be expensed over time, current accounting standards prevent non-amortization with impairment testing because it provides more useful information to investors. And the last of the goodwill is bargain purchase. So a bargain purchase occurs when a company buys another business for less than the fair value of its net assets. So the difference is recognized as a gain by the purchaser. It is because companies could misuse valuation to report higher gains, and then the ISAB requires disclosure of the transaction details.
Hello everyone, my name is Prita Luneta K with last digit NPM 171. In here I will explain about the impairment of intangible asset. So intangible asset are non-physical resource that hold long-term financial value for a business. So for impairment of intangible asset, the specific procedure, there are two types, depends on the types of intangible asset. So the first one is limited life, the second one is indefinite life. So impairment of limited life intangible, uh, we will talk about the impairment of limited life intangible. So in this method, we test it when the impairment indicator exists. So it only be tested when there's impairment in the indicator. Like example is there's a change in like a law in the country that may affect the company. And also based on IFRS to check impairment of limited life intangible asset, we only using one step approach, which is we compare the assets carrying amount to its recoverable amount. If the carrying amount is bigger than recoverable amount, it indicates that the company have impairment. Meanwhile, if the carrying amount is lesser or smaller than the recoverable amount, it indicated that there's no impairment happen in the company. Okay, I will ex I will give you some example for the first type. So the impairment in here I have impairment loss on a patent with the large company. So large company has a patent on how to extract oil from cell roach with the carrying value 5 million at the end of 2021. Unfortunately, several recent non-cell oil discovery adversely affected demand for cell oil technology, indicated that the patent is impaired. So let's determine the recoverable amount for the patent using the value in use at 2 million based on discount expected net future cash flow at its market rate of interest. So when we want to determine whether the company in impairment or not, we should compare the CA with the RA. We know the CA is 5 million, meanwhile the RA is 2 million, which is CA is bigger than RA. uh, it means there's impairment in large company. Okay, we already know that there's impairment, but we haven't know yet how much loss of impairment in the company. So we will calculate how much the loss of impairment and how to journalize that. So to know how much impairment we lose is we minus the CA with the RA, and then we got 3 million as the amount of loss on impairment. After that, we recorded record loss on impairment in debit with the amount 3 million, and then patent in credit with the same amount on which is 3 million. So after that, we know that the new carrying amount is 2 million, which is we got after we deduct the previous carrying amount minus by loss on impairment, which is 3 million, and then we got the new carrying amount, it is 2 million. And then how about if in the future there's some change in the impairment? And then what we do is just reversal of impairment loss. How we do that? So how it will be do is we just we just uh find how much it increase, and then we just reversal the journal. Okay, like in the previous one is loss on impairment on debit side, and then the patent in the credit side, and then we will reverse it, patent in the credit side, meanwhile the loss on impairment, or maybe we can change it in the recovery of impairment loss in the credit side, and then it's just like that. So we will move to the next one is impairment of indefinite life intangible other than goodwill. The company who use this test will have obligation to do it annually, minimum once in each period. This is the key difference between this method with the previous one. If this previous one, the company not have the obligation to do it annually, the company just run the test when the impairment factor is happen, impairment indicator is see or feel by the company. Otherwise, there's no need to run the test. So to test impairment with the indefinite life asset other than goodwill is actually the same with the previous one, which is we compare the CA with the RA, or we compare the carrying amount with the recoverable amount. If the CA is bigger than RA, it indicated there's impairment. If the CA is smaller than RA, it indicates there's no impairment. Next is impairment of goodwill. So this impairment is conducted based on the cash generating unit to which the goodwill is assigned. So, like example, there's evaluating goodwill impairment in the Colby's company in the pre-division. So the carrying value of the pre-division is 2.4 million. Meanwhile, the recoverable amount of the pre-division is 1.9 million. The carrying amount is included the goodwill itself, which is cost 900,000. So we will find whether the company or the division is in impairment or not. So we know the CA is 2.5, meanwhile the RA is 1.9. We know that CA is bigger than RA, it means their impairment. So we will find the amount of impairment loss it happened. So CA minus by RA, and then we got the 500,000 as the loss on impairment. The the loss itself is gonna be it's gonna be done in the goodwill account. So if we journalize it, uh, loss and impairment will be on the debit with the amount 500,000. Meanwhile, in the credit side, we got the goodwill account with the amount is 500,000. And then after that, we deduct the carry-on value of the goodwill, which is before that is 900,000, and then we manage it with the loss on impairment, which is 500,000, and then we got the current value of the goodwill right now is 400,000 only.
Okay, now I'm going to be explaining about accounting and presentation for R&D and similar costs. Actually, is while R&D costs are not intangible asset, they are often the precursor of to creating them, such as patent and copyright. Firstly, is regarding identifying research and development activities. IFRS itself distinguishes between the research phase and the development phase. Firstly, is about the research activity where it involves original and planned investigation aimed at gaining new scientific or technical knowledge and understanding. For example, is including searching for alternative for material or processes. Nextly is the development activities where it involves application of research finding to a plan or design for producing new or significantly improved product or processes before commercializing it. And the exception for this is R&D does not include routine or periodic alteration to existing product or production line, even if this represent improvement. Secondly is accounting treatment for R&D cost itself. The general rule is that research costs are expensed as incurred, while development costs are only capitalized once economic viability is reached. The for the specific cost category and their treatment are firstly is about the material equipment and facilities, where the entire cost is expensed unless the item have alternative future uses. If they have future use, they are carried as inventory and or capitalized. Secondly is personnel, where it includes salaries, wages, and related costs for staff engaged in R&D are spent as incurred. And thirdly is purchase intangible, where these are recognized and measured at fair value following initial recognition. They are accounted for based on their nature as limited life or indefinite life asset. Fourth is contract services, where costs for R&D services performed by third party are spent as incurred. And lastly is indirect costs, where reasonable allocation of indirect costs is included in R&D, but general and administrative or G&A costs are excluded unless they are related to the R&D activity itself. Okay, next on the discussion is about accounting for similar costs on R&D or costs that are similar to R&D costs. There are several types of costs that share the same characteristic. Firstly, is startup costs, where it is costs that are incurred for one-time activity to open new facility, introduce a new product, or start business in new territory. This must be spent as incurred. Nextly is initial operating loss, where it is especially prohibit the capitalization of operating loss incurred during the early years of businesses. Third and last is advertising cost, where it is generally spent as incurred, while brand value is significant. It is typically not recorded on the statement of financial position due to high level of subjectivity. And number four is the discussion of presentation and disclosure, where company must follow specific reporting standard so that it ensures transparency regarding their R&D costs or investment. First is income statement, where company must present amortization expenses and any impairment losses related to capitalized development costs. Next is statement of financial position, where all intangible asset other than goodwill should be reported as a separate item. Goodwill, if is presented, it must be also reported separately. And for disclosure itself, financial statement must disclose the total amount of R&D costs charged to expense in its periods. For example, as the picture beside this presentation, this slide is there is Glaxo Smith Kline or GBR report R&D expenditure as a distinct line item on its income statement and clarified in its note that research is expensed while development is capitalized only after meeting specific asset recognition criteria. For example, as such as regulatory filling. Next.
Okay, that's all about our presentation from Group B. Thank you so much for your attention.